Alex was convinced he had cracked the code to smart money management. He had diligently researched and moved his funds to a high-yield savings account, boasting an impressive 4.5% return. He knew, with a certain pride, that conventional savings accounts were little more than a financial illusion, offering meager returns. While the average person was content with a paltry 0.45%, Alex was earning 10 times that, believing he had outsmarted the system. But he hadn't. Not really. His bank was still pocketing a significantly larger profit from his deposit than he was. In fact, the very strategies his high-yield account was employing to generate those returns were ones he could have executed himself, thereby retaining the entire yield. Here is the part that truly stings. His colleague, Sarah, still had $20,000 languishing in a traditional savings account. Over the course of 1 year, her bank paid her a mere $76 in interest. That same year, the very same bank took Sarah's $20,000 and shrewdly leveraged it to generate over $1,200 for themselves. She received $76, while they kept the lion's share, and in a perverse twist, she likely thanked them for it. Sarah was utterly unaware that she was, in essence, losing money by keeping it there. Alex believed he had fixed the problem, but both he and Sarah were, in different ways, misinformed. Professor Sterling meticulously crunched the numbers for both of them, revealing the startling truth your bank would rather you never see. Sarah, by all conventional measures, did everything she was advised to do. She diligently saved 6 months' worth of expenses, carefully depositing it into a savings account at a prominent national bank. Each month, she checked her balance, observing a tiny interest deposit. It wasn't much, a few dollars here, a few dollars there, but it instilled a sense of financial responsibility and, crucially, safety. Her savings account was yielding 0.38% APY. This rate, according to FDIC data, represents the current national average. On a $20,000 balance, that translates to $76 annually, or a meager $6.33 per month, barely enough to cover the cost of a modest lunch. Now, Sarah likely never paused to consider what her bank was actually doing with that $20,000 while it passively resided in her account. She probably assumed it was simply sitting there in some secure vault, patiently awaiting her next withdrawal. But that assumption was profoundly mistaken. The very moment Sarah deposited her money, the bank immediately put it to work, not for her benefit, but for theirs. Let's delve into precisely how Sarah's bank utilized her $20,000. The primary action her bank took was to lend it out. This, fundamentally, is the core business model of virtually every bank in America. They accept your deposit, offer you a minuscule fraction of a percent in return, and then lend that same money to someone else at a significantly higher interest rate. The critical difference between the rate they pay you and the rate they earn is termed the net interest margin. Currently, the average net interest margin for U.S. banks stands at 3.39%, the highest it has been since 2019. To put this into tangible figures, Sarah's bank paid her 0.38%. They, however, earned an average of 3.39% on the money they lent out, directly utilizing her deposit. On a $20,000 deposit, this translates to a spread of approximately $602 per year that the bank effortlessly pockets. Sarah received $76. The bank generated 600 bands, and $2 from the exact same $20,000. But that's merely the average. Let's examine where the truly expansive margins lie. Credit cards. The average credit card, APR, in the first quarter of 2026 is projected to be 21%. Sarah's bank takes deposits like hers, pays her 0.38%, and then promptly lends that money to credit card holders at a staggering 21%. That represents a spread of over 20 percentage points. If the bank allocated even a fraction of Sarah's $20,000 deposit toward credit card lending, the profit derived from that sliver alone would utterly dwarf the $76 they paid her for the entire year. Consider auto loans. The average rate on a new car loan right now is around 7.5%. Mortgages average approximately 6.8%. Personal loans typically hover around 12%. Every single one of these lending products is funded, at least in part, by deposits just like Sarah's. And every one of them generates multiples of what Sarah receives in interest for the bank. Then there's the Treasury trade. This particular strategy should genuinely make you pause and reconsider. Sarah's bank allocates a portion of her deposit to purchase short-term U.S. Treasury bills. As of now, 3-month T-bills are yielding approximately 3.6%. The bank acquires these treasuries using Sarah's money, earns 3.6%, and in turn, pays Sarah 0.38%. That's a 3.22% spread on an asset that Sarah could have easily purchased herself. The bank is quite literally acting as an expensive middleman between Sarah and the U.S. government, charging her over 3% for the mere privilege. And let's not overlook the ubiquitous fees. American banks collectively garnered an estimated $12.1 billion in overdraft fees, NSF fees, ATM fees, maintenance charges, and various other service fees in a single year. J.P. Morgan Chase alone collected over $1 billion in overdraft fees in 2024, with Wells Fargo accumulating a nearly identical amount. These substantial fees are levied upon the very same customers whose deposits fuel the bank's lucrative lending operations. Sarah's $20,000 is an integral part of this vast financial machine. This doesn't even account for the interchange revenue earned every time Sarah swipes her debit card, where the bank pockets a cut from the merchant. Nor does it factor in the float, the earnings the bank generates on pending transactions, holding your money for a day or two before it actually clears. And we haven't even touched upon the anonymized data derived from your spending patterns, which banks package and share with their marketing partners. Each of these represents another channel of substantial profit, meticulously built upon the foundation of Sarah's deposit. When you consolidate all these elements, the picture becomes unequivocally clear. Sarah's bank didn't just hold her money, they effectively rented it. They paid her $76 a year for the right to utilize her $20,000 in any way they desired. And all along, she believed she was simply earning interest. Now, let's turn our attention to Alex. Alex is undoubtedly the individual watching this presentation thinking, "Knew all of this. That's precisely why I moved my money to a high-yield savings account." And Alex isn't entirely wrong. He is indeed significantly ahead of Sarah, perhaps by a considerable margin. His high-yield savings account offers a 4.5% APY, a stark contrast to Sarah's 0.38%. On a $20,000 balance, Alex is earning approximately $900 per year, compared to Sarah's meager $76. He did his homework, he made the switch, and he's now earning 10 times more than the average saver. So, what exactly is the lingering problem? The first challenge is that 4.5% might not represent what Alex is actually earning. Many high-yield savings accounts boldly advertise an up to certain rate, and that seemingly innocuous up to is doing a great deal of undisclosed work. Accounts employ tiered rate structures, where the highest rate only applies to the initial $500 or $1,000 of the balance, after which the rate precipitously drops. Others entice customers with a promotional rate for the first 90 days, only to quietly reduce it thereafter. Alex saw 4.5% prominently displayed in the headline. His effective rate could very well be lower. The second issue lies in the tax treatment. Interest earned from any savings account, whether it's a traditional account or a high-yield account, is taxed as ordinary income. This means it's subject to federal taxes, plus potentially state and local income taxes. If Alex falls into the 22% federal tax bracket and resides in a state with a 5% income tax, he's effectively losing over a quarter of his hard-earned interest to various taxes. His gross $900 income is reduced to roughly $657 after taxes. The third and arguably most significant problem is what Alex's high-yield savings account is actually doing with his money. Where, one might ask, do you imagine the bank acquires the returns necessary to pay Alex his 4.5%? They are engaging in precisely the same practices we just meticulously detailed with Sarah's bank. They are lending it out. They are buying treasuries. They are running the exact same profit-generating machine. The sole distinction is that a high-yield savings account chooses to share a slightly larger slice, that generated profit with the depositor. But it remains just a slice. The bank continues to operate as the middleman, and the middleman invariably continues to take a cut. Herein lies the crucial question Alex never thought to ask. If the bank is utilizing my money to purchase Treasury bills and earn 3.6%, why shouldn't I simply buy the Treasury bills myself? Professor Sterling ran the numbers for a direct comparison. The same $20,000 over the same 12-month period under three distinct scenarios. Scenario 1, Sarah's traditional savings account yielding 0.38% APY. Her gross interest earned is $76. After accounting for federal and state taxes, she keeps roughly $55. That's the actual monetary reward her responsible saving earns her in a full year. Scenario 2, Alex's high-yield savings account, yielding 4.5% APY. His gross interest earned is $900. After federal and state income taxes, totaling a combined 27%, he retains approximately $657. This is undoubtedly a vast improvement over Sarah's situation. However, it's crucial to note that he is paying taxes at both the federal and state level on every single dollar of that interest income. Scenario 3. Investing in a short-term Treasury bill, ETF, such as SGOV. SGOV's 12-month trailing yield as of April 2026 is 3.95%. The 30-day SEC yield of 3.55%. On a $20,000 investment, that translates to approximately $790 in gross income over a year at the trailing yield, or about $710 at the current 30-day rate. Now, this is where it gets particularly interesting. Interest derived from U.S. Treasury securities is explicitly exempt from state and local income taxes. This is established federal law. So, while Alex pays federal plus state taxes on his $900, SGOV investor pays only federal tax on their $790. After taxes, the SGOV investor keeps roughly $616 at the trailing yield. And critically, this is achieved without incurring any state or local tax obligations. Now, you might observe these figures and think, wait, Alex's high-yield account still appears slightly ahead in raw dollar terms. And in this specific, isolated comparison, yes, 4.5% is indeed numerically higher than 3.95%. But here's what that direct comparison crucially overlooks. Alex's 4.5% is an advertised rate, subject to change at any moment without prior notice. The bank could arbitrarily drop it to 3.5% next month, and merely send him an email informing him of the change. SGOV's yield, conversely, directly tracks the actual Treasury bill rates, which are transparently determined by U.S. government auctions. It's a market-driven, transparent mechanism, entirely devoid of bait-and-switch tactics. Furthermore, Alex's 4.5% is fully subject to state income tax, whereas SGOV's yield is not. In states with high income taxes, such as California or New York, state tax exemption alone can more than compensate for any perceived yield difference. Finally, Alex's 4.5% still involves the bank acting as a costly middleman. SGOV, by contrast, completely cuts the bank out of the equation. You are lending directly to the U.S. government through Treasury bills and retaining the full yield, minus a minimal 0.09% annual expense ratio. The overarching point is not that one option is inherently superior to the other in every conceivable scenario. The fundamental takeaway is that Alex was never even aware this direct option existed. He mistakenly perceived the high-yield savings account as the ultimate finish line, the pinnacle of smart saving. It's not. It's merely a more comfortable, albeit still subordinate seat within the very same financial machine. Here's what Professor Sterling thoughtfully recommends, and it's far simpler than most people might assume. First, maintain your checking account. Do not close it. You undeniably still require it for daily expenditures, rent, utilities, groceries, and any other regular incoming and outgoing transactions. This isn't about radically altering how you spend money. It's about intelligently repositioning where your idle money resides. Second, precisely identify your idle cash. This encompasses your emergency fund, your general savings, any cash temporarily waiting to be invested, or funds you're specifically setting aside for a significant down payment or a major purchase. This is the capital currently sitting in a traditional savings account, earning next to nothing, while your bank effortlessly generates 10 to 50 times more from it. Third, here are your strategic options for relocating that idle cash. Option 1, a Treasury bill ETF such as SGOV. You can readily purchase it through any standard brokerage account you already use, be it Robinhood, Schwab, Fidelity, Webull, or any other platform. You acquire it just like you would a stock. ETF then takes your money and strategically invests it in U.S. Treasury bills that mature in 3 months or less. Every month you receive a dividend which represents your interest income. Currently, this is yielding approximately 3.55% to 3.95%, depending on the specific metric you consult. When you eventually require your money back, you simply sell it during market hours. The price remains remarkably stable, hovering right around $100, as it is specifically designed to do so. The annual expense ratio is a mere 0.09%. On a $20,000 investment, this translates to just $18 per year. And crucially, your distributions are entirely exempt from state and local income tax. Option 2, treasurydirect.gov. This is the official U.S. government website where you can directly purchase Treasury bills. This method eliminates all intermediaries. No brokerage, no ETF, no expense ratio whatsoever. You establish an account, securely link your bank, and then acquire T-bills directly at auction. Upon maturity, you receive your principal back along with the accrued interest. The main drawback here is that it's less liquid than an ETF. You are committing to a specific maturity date, ranging from 4 weeks to 52 weeks. However, if you don't require immediate, instant access to your funds, this represents the purest form of completely cutting out the middleman. Option 3, a money market fund. These funds are commonly offered by major brokerages like Fidelity, Schwab, and Vanguard. They primarily invest in a diversified portfolio of short-term government securities and other high-quality short-term debt instruments. They provide daily liquidity, meaning you can typically withdraw your money at any time. Their yields are currently highly competitive with high-yield savings accounts. And if you strategically select a Treasury-only money market fund, fit from the same valuable state tax exemption as SGOV. Now, here's the most common objection people typically raise. But my savings account has FDIC insurance. And that assertion is entirely correct. FDIC insurance provides coverage up to $250,000 per depositor per bank. If your bank were to fail, the government unequivocally guarantees the safety of your money. This is a very real and significant protection. However, it's vital to consider what you're truly comparing it to. Treasury bills represent debt issued by the very same U.S. federal government that underpins and backs the FDIC. When you purchase a Treasury bill, you are directly lending money to the government itself. The risk of default on U.S. Treasuries is, for all practical purposes, essentially zero, primarily because the government possesses the inherent ability to print money to fulfill its debt obligations. You are not sacrificing safety when you transition your money from a savings account to Treasuries. Instead, you are moving from a government guarantee on your bank account to directly lending to that very same government. In some fundamental respects, it's an even more direct and robust form of security. The second common objection is, I need instant access to my money. This is a fair point. And that's precisely why you maintain your checking account, keeping it adequately funded for your immediate daily needs. For your emergency fund, when held in an instrument like SGOV, yes, there is typically a 1 to 2 business day settlement period when you sell. Let's be honest with ourselves. When was the last time you genuinely needed $20,000 in cash within a mere 60 seconds? In the vast majority of real emergencies, 1 to 2 business days for settlement is perfectly acceptable. And the substantial difference in yield you stand to earn while you wait for that hypothetical emergency to materialize amounts to hundreds of dollars per year. Sarah was responsible. She meticulously saved her money. She entrusted it to a bank. She diligently checked her balance. By the conventional rules she was taught, she did everything right. Alex was informed. He proactively moved his money to a high-yield savings account. He earned 10 times what Sarah earned. He truly believed he had cracked the financial code, but neither of them ever bothered to ask the truly foundational question. What is my bank actually doing with my money? And could I simply do it myself? The unequivocal answer is yes. Your bank accepts your deposit, buys Treasuries, lends it out at 7%, 12%, or even 21%, and then pays you a minuscule fraction of a percent. The smartest financial move isn't endlessly searching for a better savings account. It's questioning why you feel you need one at all. This video has shed light on something you were previously unaware of regarding your own money. Please consider subscribing to Wealth Logic and hitting the notification bell. We are dedicated to breaking down the hidden mathematics and unspoken truths behind the financial decisions you navigate every single day. And our next video? That's one you absolutely won't want to miss.